Good morning, everyone, and welcome to CB3 Financials Weekly podcast with market insights and commentary from me, your portfolio manager, Charles Brown. So coming on the show here, we're breaking down Friday's non-farm payroll. Now, you realize we didn't cover this in last Thursday night's CB3 Live because the data was not issued yet. So that's the number that we have for you today. We're going to preview what that means for what's a blockbuster week of earnings, and we're going to take a look at seasonal tendencies for the second full week of January, and give you a preview of our 2026 annual letter to investors landing in your inboxes this Thursday. CB3's weekly podcast begins now. Welcome back. Let's dig into the employment picture because Friday's jobs report looks like a more nuanced story than the headline suggests. So the economy added just 50,000 jobs in December, falling short of the roughly 70,000 that economists had forecast. But context matters here. First, the good news. The unemployment rate ticked down to 4.4% from 4.5. There were even some predictions it might even rise to 4.6. So that's the lowest reading in 4 months, and it came in below expectations. That's great. So for Fed watchers, that's a relief. Chair Powell and the rest of the Fed have been keeping a close eye on any deterioration in the labor market, and this reading suggests that we're not sliding backwards. Now the less encouraging details. Prior months saw significant downside revisions. 76,000 jobs were stripped from October and November combined. October's number was revised down by 68,000 to show a loss of 173,000 positions. November was trimmed by 8,000 to just 56,000. So the government shutdown likely distorted the October data, but the pattern of downward revisions is becoming a recurring theme and not a good one. Looking at sector performance, the usual suspects continued to carry the load. Food services, drinking places added 27,000. That's been a steady contributor. Healthcare added, social assistance, another 17,000. But where are we losing? On the retail trade side, 25,000 positions. That means warehouse clubs, supercenters, general merchandise retailers, etc. Wages held steady, though. The average hourly earnings rose 0.3% month over month to $37.02. That's not bad, actually, for a year-over-year gain at 3.8%. That's not accelerating so much, but it keeps the inflation hawks at bay. And if we can keep the inflation hawks at bay, then we have a chance of having lower interest rates moving into the heart of 2026, and that's certainly what we want. So here's the big picture for all of 2025. The economy added just 584,000 jobs. Now, that's an average monthly gain of 49,000, but just think in a regular year, we should have 1 to 1.2 million new jobs. So the economy is just not that strong for the job market. But outside of recession years, this marks the weakest annual employment growth since 2003. That's a long time ago, but the reality is it is still growing, all right? So I'm not that concerned. I am somewhat concerned, but that doesn't do anything to change our investment profile, which is fully invested. One area of concern flagged by multiple economists is that youth unemployment's climbed to 10.4%. All right, so workers 16 to 24, up 9.4% a year ago, 8% in December. Long-term unemployment not looking good for these much younger workers. And that's because older workers are staying on the job longer. What does this mean for policy? Well, Jay Powell's last meeting, it looks like, is going to be January 27, 28. The FOMC has about an 88% chance of lowering rates according to the futures markets. I don't know, but it's going to happen based on what we're seeing in this report. This will be the last report before they meet. So we will see, as we say all the time, we will have to just wait and see what the Fed does coming up. So now let's turn to what's shaping to be a pivotal week on the earnings calendar. And if you remember, earnings and interest rates are mostly what drive the market. Geopolitical concerns do have an influence, but in the long run, after all the histrionics have worked out, it is earnings and interest rates that drive the returns in the market. So on Tuesday, January 13th, that's tomorrow, JPMorgan leads off. The street's looking for strong earnings there. And then the next day, Wednesday, brings a triple header. Bank of America, Citigroup, and Wells Fargo. Analysts expecting Citi's earnings to surge more than 30%. We hope that's the case because we hold quite a few financial companies, not all of these that I've mentioned, but some of them, and then some smaller banks in GI. We want to see growth in GI this year. It didn't have a great year last year, even though it's paying a lot of dividends. Thursday rounds out the week with Goldman Sachs and Morgan Stanley, the investment banking heavyweights benefiting most from the M&A revival, that's mergers and acquisitions. So global deal volume hit $5.1 trillion. There is still buying and selling of big multi-conglomerate companies happening every single year. So $5.1 trillion in 2025, up 42% from the year before. So those are the themes to watch. Investment banking fees, which for them is good. We don't want to pay them as consumers, but we, as customers of their stock or owners of their stock, we want to see those rise. And several banks have guided to low double-digit gains. We will, just like the Fed, see how this plays out in the next week or so, and I'll give you an update probably ahead of the February CB3 Live. So as we enter the second week of January, let's talk about seasonality. The S&P posted strong gains in the first 5 days of the year. Historically, when the first 5 days are positive, and these were, the market finishes higher about 83% of the time. 83% of the time, going all the way back to 1950. There's also the January barometer. As January goes, so goes the year. So we'd love to see this month end on a positive note because that is a precursor to the rest of the year also finishing on a positive note. S&P average returns about 17% for the full year when January is positive. When it's negative, it's a whole different story. We'll have more on that later on in the month when I have the next podcast, and we'll see what has happened since then. But January is definitely a bellwether month. So one more note, small cap stocks are showing relative strength, and that is good. We need small cap stocks to participate in the upside rally. The Mag 7, the Magnificent 7, can't just keep carrying this rally all by themselves. It's just not healthy for the market. So we want to see small caps. That's the Russell 2000. We have quite a few Russell 2000 stocks in DS and even CG. And finally, I just want to give you a heads up that this Thursday we are planning to drop, which means email to you, our 2026 annual letter, looking back on 2025. We're going to take an honest look at it. 2024 was a stellar year for all three of our programs. 2025, not so much. But we made some fundamental changes. The first thing that we did is move everybody from Interactive Brokers to Schwab, where we have a lot more flexibilities in the strategies we're able to offer, specifically block trading of the options hedging. All right. We also switched from weekly signals with stops on stocks placed in the market to monthly signals, which means we're trading less frequently. A month like April last year, when basically all of the year's losses, significant losses, happened in November and April. Those were two different situations. I'll cover those more on the next show. But the reality is that we are better prepared than we have ever been now that we are with a broker-dealer that allows us to hedge effectively all three of our programs. So we're reaffirming our core principles, a clear process, which I've laid out through the last several months of the CB3 Live show, a repeatable system, and a disciplined portfolio management, and a documented framework that works to your benefit as an investor. You're going to find this with all of our programs. Looking ahead, we enter 2026 fully invested, also fully hedged, and aligned with long-term secular trends in AI, cloud, quantum computing, and next-generation infrastructure, meaning data centers. If you're a client and you don't see the letter by end of day business, check your spam folder or reach out to us directly. Guys, that's the end of the show for this week. Thank you so much for listening. If you have questions, cb3@cb3.com, or you know my phone number. We will see you for the next podcast and, of course, the February show for CB3 Live, when we'll know a lot more about earnings for the fourth quarter of 2025. We will see you then.